Hello, welcome back to Hurdle Rate. Today we're going to build a DCF from scratch for AppLovin. We're going to build the DCF, the actual DCF, as well as the cost of equity and the weighted average cost of capital all in one video. So yeah, let's get cracking. AppLovin is a company that builds, it helps out developers monetize through advertising and acquiring users. And over the last 5 years, the shares have been on an absolute tear from a low of about $10.23 up to just 682 earlier this year. And they've started to pull back a bit. And as you can see, it's had sharp pullbacks in the past. The reason I've never really followed this company, but the reason I want to today is it's recently joined the S&P, and it's actually profitable. So I think it would be interesting to see where it's going, even if it's still in a fairly high growth mode. So yeah, first things first. Let's pull up our financial statements. Go onto the SEC website, pull up the latest 10Q, and this is the 10K and the latest 10Q, and we can get started. Open your spreadsheet. First things first, as always, remove the grid lines. Let's go View, freeze the first column. Then let's insert another column before A. Make A a bit smaller, make B a bit larger. There we go. In A1, put the ticker for AppLovin, which is App. Make sure not to get it confused with APPL, which is Apple. So, data, select data, go stocks, and it's going to find up, we're going to be able to pull a bit of it automatically, but most of all we have to, there we go, AppLovin. AppLovin Corporation is listed on the NASDAQ. Select that one, and there we have it. In this, let's start filling out what we usually do. So we go ticker, date. We want, say, current price, implied. We want to know if there's any up or downside. In all of these, let's just fill them. Border. There we go. Copy this over. No, sorry. There we go. Ticker equals A1 dot, open the parentheses, ticker symbol. For current price, again, A1, open the parentheses, price. There we have it. The date today is the 12th of October, 2025. And now let's move on to our assumptions. Put a little X here. Let's do a bit of formatting. Center. I think we probably need to go to M. Use this, I like to use this blue font. We go assumptions. And here we're going to put revenue segments, switches, then we want to have a bear, base, bull scenario, which we're going to simulate. Okay, we don't really know what the, we don't have to do the formatting just yet. Let's pull up this one's the revenue breakdown so we know what segments we're working with. Okay, this is good. It tells us United States revenue here versus the rest of the world. So pretty much 50% of the revenue is coming from the US and the rest is coming from the rest of the world. But we want to find a breakdown of where their revenue comes from. Here we are. No, that's not what I want. Oh, okay. So earlier this year in May, AppLovin divested their apps business. Therefore, there's only one reportable segment, which is the revenue. So instead, we'll just focus on these two: the United States and the rest of the world. Um, that's what we'll use as the revenue segments rather than components of the business, because they're saying now that the company's pretty much focusing solely on on the advertising side. So yeah, so they've sold that part of the business, the apps part, and so it was half cash, half stock in Triple Dot, meaning that it should, well, when we look at the cash later, it should show up there when we're calculating the DCF. So yeah, let's just do it this way for now, and we'll see how they do on the next 10K, how they start reporting things. Sorry, I sound a bit rough today. I've got a bit of a cold, um, but let's get this done. It sort of makes it a bit easier to. We're being able to do it in, say, just US and the rest of the world as a segment, it makes it a bit easier. And when we work out what our equity risk premium for the company is later on. So yeah, let's do it. Let's go income statement. Base, no, sorry, bear, base, bull. Just move those down and put percentage growth here, italicize it. These three, just indent them slightly, and then we want the percentage of revenue at the bottom here. Equals B11, I think. Rest of the world, yeah. And we're starting 2022. So go 20. The next cell, just go the previous plus 1. Pull it along until we get to 2030. 1, 2, 3. Yeah, yeah. We don't need these. Yeah, we can all see. That's good. Let's start. So 2022, this is on page 69, US and rest of the world. This is now, I mean, as we said, because they've divested this part of the business, it's no longer useful. I think they sold it for, it's got the number up here. Here we are, divestiture, 715 million, which was 430 million in cash and 285 in stock of Triple Dot, the acquiring company. So yeah, okay, come back to the 10K. 2022 17, and this is done in thousands, these revenues, but we're looking at this in millions. So we're going to go 1728.958, and let's do the formatting how we all like it. Number, remove the decimal places, thousand separator, and do the negative numbers in brackets. Okay, looks good. Then we have 1970.856, 2688.993. And to find the growth, we take the year divided by the previous year minus 1. Then just pull that across. We do the same for down here. Let me just pull the formatting to it. There we go. 1088.100, 1312.231, 2. There we go. Okay, let's pull up the. Okay, so In 2024, the company did nearly 2.7 billion in revenue in total, but halfway through, they'd only done 775 million. So what that is as a ratio is 774 point. So 3.5. Well, let's do the same, because this is a very fast growing company in terms of top line. But let's have a quick look at the app's revenue is about 30. It's about a third of total revenue. So if we did this and then we multiply it by, yeah, then we multiply it by 0.66, and that should give us, yeah, I think that could be more realistic, because that revenue is now with Triple Dot, and they have the 715 in cash and stock. So yeah, let's go with that. We'll obviously update it as more of the earnings results come out. And so rest of the world divided by 614. So if we do 1143.704 multiplied by 3.28817 multiplied by 0.66. Okay. Now we're going on to our forecasting. We'll take an average of the previous years. And what should we say? So if this is at, let's say, 20% now, let's put it that it eventually heads to 15. And maybe rest of the world can grow, so it will go to 20. Okay, so now we do equals, we take the previous year, subtract, open your brackets, the previous year minus the final year, close brackets, divided by the 2030 minus the previous year, close brackets. Now we want to lock in, what do we want to lock in? We want to lock in the column, but not the row for K25, or whatever it is on your own. We want to, this will always stay the same. This will always stay the same. So it's lock in both. And for this, we want the row to always stay the same, but not the letter. Not the column, sorry. Okay, it's going to go big, and we just need to reformat this column back to, oops, sorry. Format column width to 10. Percentage, I like to keep these in 2 decimal places. Put it along. There we go. And in terms of a bear case, I'm going to put 90% on both, just because there have been, I mean, short sellers have attacked the company saying it's inflating its user data and all of these things. So if there is an investigation into that, it could have quite negative impacts. So now lock in E10, because it always wants to be there. Pull it along. We do the same here, and we put I10, but it needs to be G25. There we go. For this next bit, so put 2's here because that's the base case. And we go equals, offset, the cell that we're in, G23, the switch, C10, but lock in the switch. And you just put $sign before the letter and the number. And then just put a 0 after it, sorry, put a 0 after it. So if you put this in, there we have it, just format, pull it across. Perfect. To calculate the revenue out, you just take the previous year, multiply it by 1 plus the growth rate. Then there we are. We're going to do the same now, so we can take this, paste it down here. We just have to change this to E11 though. This one needs to be I11. And this needs to be G11. There we go. Again, copy it down. We just go change it to C11, pull it across. And there we have it. There we have our revenue forecast for the next 5 years. Sorry, one second, put this back. What we want to do now, I'll show you what the reason for doing this. So remember these numbers, 3491, 4136. Let's go on the bear case, which is 1, comes down. Let's go on the base, comes back to normal. Then we go 3, and it goes higher. So we can use this to simulate different scenarios on all of the key drivers of the company. Yeah, we need to just do our totals. Border, put a thick line, not a thick line, but a line. And we go total revenue, make this in bold, and this is just equals sum. Bold it, pull it over. There we have it. We can fill out these the percentage of revenue. Sometimes it's just good to know. So when we're doing the forecasts further down the line, how that changes. So as we can see, percentage of revenue for the US has gone from 60%, and it could potentially go down to 47% as the company grows in the rest of the world. The fact that at the moment revenues are for the rest of the world are pretty much equal to the US shows just how much growth potential there probably is for the rest of the world, which is probably why the company is valued so highly. There we go. Perfect, looks good. Sorry, this should be revenue build, because we're now going to go on to income statement. Start with revenue, go equal, make sure it is equal because we want it dynamic. When we're changing, simulating, and it's affecting down here, we want it to affect here as well as it goes down the thing. Everything in the DCF is connected. I know I keep saying the same thing in each of the videos, but it is, yeah, it's very, very important. Okay, come back up to the income statement. Where is it? Here we are. So we want to see income loss from operations. So in the last few years, it has become profitable, which is why I guess it becomes more suitable to do a DCF. Maybe it's maybe not the perfect company for a DCF where it's more predictable cash flows, but it's an interesting one to do. So let's do it. So the EBIT was negative minus 48 million for 2022, but then it swung into positive at 648 million. Then it's 1.873. So I think the EBIT's pretty good. For 2025, where are you? Oh, no, sorry. Got it. Here we go. So income from operations. This is what we want. So 2024 they did 1.873. Divide that by halfway through the year they were doing 748. So it's 2.5. Let's apply the same for 2025. Wow. That's huge. Forecast it out. I mean, it's not going to stay at that, but maybe. When we look at the taxes, we want those as a percentage of EBIT. So they were actually making money from that. So let me just make sure I've got something right. Yeah, it's fine, it's good. Taxes, so come back onto this, the 10K. They spend 23. Minus 3.771. There we go. Ooh, so they were paying 50 million in taxes for the first half of 2024, and then they swung into getting paid 4 million. I think it's going to, we need to have it come to a sensible tax rate though. So let's say it's going to be 183. Let's times that by 1.5 because it is a profitable company now. They will be having to pay. I don't think they're keen getting these offsets. So yeah, let's do it like that. 6% for this year, and then let's put it to. I mean, what would be the? Let's see if they say what their effective tax rate is. Okay, income taxes. Okay, it hasn't said what it's. Usually, yeah, you can find it somewhere. It's hidden with. Okay, well, I mean, look, it hit about 8% here. So let's say it just goes up to 10%. Just copy that all the way along. Okay, no, let's be a bit more. Let's just keep increasing it that way and say that it eventually gets to a much higher tax rate. Okay, looks good. Now we're going to go into the cash flow items. These are depreciation and amortization. We want the capital expenditures. And then the change in net working capital. Looks good. And these are all on the cash flow statement, which is near the top. So you have balance sheet, your revenue. Here it is. So for 2022, 547,489, yeah, perfect. This is huge depreciation. I mean, even at 10%, it's quite a lot. The capex, this one, 662, 4246, 4776. Wow. Yeah. Okay. So they're really building out their infrastructure. Change in net working capital. That's just the sum of all of these. Yes, so 2022, we go equals, and you know what? I think this could actually work in their favor. I think it's going to be negative. Yeah, it will be negative, meaning that it will be positive for free cash flow because it's like they get paid first before they deliver the product. Again, normally the change in net working capital on a more mature company is about 1% of revenue. Capex and DNA usually no more than 4 or 5%. So yeah, this is very interesting. Okay, yeah, looks good. Let's go on to 2025. Where are you there? Here we are. Just see what it was as a percentage of 22. Okay, now it's sort of going a bit more sensible. The capex. It looks like they haven't done anything this year. Yeah, okay, we'll just put 0. And then pull it, yeah, let's forecast this out. Maybe because this company's evolving so fast, the last 22 and 23 might not really matter. So let's just do the last 2 years. There we go. There we go. There was no capex. Well, let's put it to 8%. I mean, it's 0 now. Let's say, I mean, by the end of the year, let's say it's in line with what we think. No, okay, let's go to 250. Yeah, perfect. Yeah, let's go. Let's go with that. This is, yeah, it's very difficult to get a good answer on this. So, change in net working capital minus 291.551 plus 20.691 plus 91.511. What do we want to do with this? Let's leave it at that. Okay. Now we're actually building the DCF. So we pull revenue. No, sorry, revenue. And again, always make it equal to what we did before. There we go. Now, EBIT, we're going to build out our bull, base, and bear scenarios. But most of it we're just going to copy paste. Actually, let's pull this up. Equals. Don't need this one. hopefully we can just do this and copy paste. Let's copy one of these down. Okay, let's say it trends towards a 35% EBIT margin, which is, it's pretty big. This will be 13. G13. Copy from here, put it down, but remember, change this to 13. Okay, the reason it's saying that is because we haven't put our switch in. There we go. But these also need to be 13. This is going to have, because it's such a, I mean, we're putting our finger in the air and going, yeah, let's, I'm guessing that way rather than anything concrete. No, actually, I'm going to put the EBIT to lower. I'm going to put it just 25%. Because this 83% is a one-off. It's not real, I guess. Yeah, looks good. Now taxes. They equal. But only up to here. Divide by going forward, let's start increasing them. So I think, yeah, let's do it as we were here. And multiply that. Basically now it means when we change the switch here, the taxes update automatically as well. So I can show you, we're on the base at the moment, 3256, remember that number. Let's go to 3. Yeah, 3528, and it increases down here as well. Cool. Okay, now we calculate our EBIT, the earnings before interest but after tax. We just do it for what we're forecasting. So we go equals EBIT minus taxes, bold it, put it along. There we go. And then we want our DNA, our CapEx. What was the other one? Change. So yeah, just copy it down. There we go. Now we can calculate our unlevered free cash flow. Bold it. The way we do that, we go equals, we take the EBIT, we add back in depreciation and amortization because it's a non-cash expense, we subtract the CapEx, and we subtract the change in net working capital. But because this is a negative number, it will be positive. So there we have it. And then we want to do the present value of FCF. But for this, we need to build out our WACC and our cost of equity. So let's open up a new sheet. There we go. And we'll start doing that. Okay. So again, page layout, remove the grid lines. Let's make B a bit larger. We don't need to freeze the frame though, because we're not using that much of it. So what's the ticker? App. Data, stocks. There we go. So we're going to make the weighted average cost of capital. I'll just zoom in a bit more. So the WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So what do we need from here? We need the market cap, we need the percentage of equity, the cost of equity, which is composed of the risk-free rate, the beta, and what's the other one? The equity risk premium. And we'll do that on a separate sheet as well. Percent cost of equity, yeah. So then we want the debt, percentage of debt, cost of debt, tax rate, total WACC. There we go. So we're going to go into here. So market cap we can get easily. We go A1, open parentheses, market cap. Make sure to divide by 1 million though. Because that's the units we're operating in. So this is a $192 billion, nearly $193 billion company. It was probably more than 200 billion at one point before it had that pullback. The debt, we can look on the balance sheet. Probably doesn't have that much. Long-term debt, 3.5 billion. So this is a predominantly equity business. And I guess now that it is consistently profitable, it probably will, you'll see that number start to go up. It doesn't always work when you use it on this bit. You have to go like this. Yeah, okay, that's good. So the total on here is your market cap plus your debt. Then we can find our percentage of equity is 98%. Let's make it into a percentage. We do the same with the percentage of debt. 2%. Cost of debt is, we'll find that out. Maybe sometimes it says, but not all the time. Because we can just divide the interest expense by the total debt. But honestly, it really doesn't matter on this company because it is predominantly equity. Debt, where are you? Debt. Okay, it doesn't say. So let's just use the interest expense and we multiply it by 2. Okay, so equals 104.297 multiplied by 2, make sure that's in brackets, and divide it by your total debt. So it's about 6%. Then the tax rate, I mean, right now it's about 9%, so it doesn't really have a tax shield. What did we say we're going to put it at? We put it as 10% for the next year, but I mean it's 5% at the moment, so that's what we'll go with. Yeah, so we just need to do this bit now. The risk-free rate, we know that is 4.059%. The equity risk premium, so we know, okay, let's just build it out down here. We'll do the beta and we'll do the equity risk premium. So we have US, we know, so 2025 revenues equals, we'll do the ERP first and then we'll do the other one. ERP, what do we want? We want the weighted ERP, no, weight, then we have weight ERP. ROW equals so total and the beta for this is going to be quite easy because we're just going to put it as an advert from now on, just an advertising business, because that's where it's getting its revenues from. Why has it done that? So we go sum like this. Let's change this for here, and we put the weight here. The weight is divided by, just lock it in, so I can copy it down. I want it to be percentage though. And the ERP, so we're going to go on, let me call this over here. So if we take, the US is easy. Well, I mean, the equity risk premium is never easy. It's never that accurate. 4.62, and this is actually a bit out of date, but well, for now we'll use it just for the concept, and then we can, what is it, 4.62? Yeah, for the concept, and then as we know, as you guys get better in this, you put your own figures in, and you do your own research, you'll start adding your own way of doing it. ERPs by country. Actually, we want a regional weighted average. So global is 5.88. But without the US, obviously you can't really see if there's a regional breakdown. So, okay, the way we can actually do this is if I just delete North America. Okay, yeah, let's go with 6.41%. Then we do this one multiplied by this one. No. So 5.44%. Okay. Now for the beta. Okay, so what do we need for this? We need the industry. We're going to say advertising. So yeah, so what we want is the unlevered beta, the revenue, the EV to sales, the value, proportion, then we want the weighted beta. So let's come to this spreadsheet. We want advertising, actually clear. The average, no, not the average unlevered. Is that what I want? Yeah, so 1.15. Revenues is equal to EV to sales. We can find that on our price to sales data. Let me pull that up. Again, clear filter. There we go. Price to EV to sales is what we want, 2.75. The value equals the revenues multiplied by the multiple. It's 100%, meaning the weighted beta is... Oh, of course, because it's only one thing, so it's obviously going to be 1.15. So let's put it up. There we go. And your cost of equity is now your risk-free rate. I'll type it out. Okay. So cost of equity equals risk-free rate plus your beta multiplied by your equity risk premium. So risk-free rate plus your beta multiplied by your equity risk premium, and that gives us 10.3, 10.31, well, 10.32 percent. Let's just format it. No. Okay, we're ready to do this bit now, the WACC. So we want your, let's put it in brackets, percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate, and double bracket at the end because we put the tax rate in brackets, and there we have it. Just format 10.23% for the WACC. Okay, come back to the other sheet. Let's put the WACC in. The bear case for the WACC, we're going to say we add on 0.5%. We just copy that over here. We do, is it G14? And for the bull case, we subtracted because the lower the WACC, the less risky. And the terminal growth rate, I mean, it should probably be higher, but let's go with 2.5%. The bull case, we add 0.5%. For the bear, we take away, we make it into a lower. Okay, it looks good. So here we go equals, choose. It's a bit like the offset function, but a bit different. So WACC, and make sure you have these in the correct order. We're going bear base bull. Okay. Copy this down. Perfect. Now we can do our free cash flow. And this is, as always, here. So on 2026, just put a 1 above it. And do this for the rest of the years too, up to 1, 2, 3, 4, 5. And these are the years that we need to put to the power 2 when calculating the present value. So we take the unlevered free cash flow divided by 1 plus our WACC, which we lock in, up to the power of here. Then we just pull across. There we have it. Now we want the terminal value, I think. Yeah, terminal value. And that is, you take your unlevered free cash flow multiplied by 1 plus the WACC divided by the WACC minus your terminal growth rate. So the terminal value for this company is about 55 billion. But we want the present value of that now. And that is going to be, you take your terminal value divided by, again, 1 plus the WACC. No need to lock it in because we're not pulling this across. It's just going to be there to the power 5. There we go. So the present value of that is 33 billion. Now we want to find the enterprise value. And this is the sum of the present value of the terminal value plus all of the present value of the cash flows we've forecasted. So 48 billion. Now we want to add back in the cash, but subtract the debt. For the debt, we know because we've just found it out for the WACC. Where is it? Debt. But for the cash, we have to go onto the balance sheet again. And what we're seeing are... No, let's go to the very top. I'm on the wrong one, sorry. Assets. So right now, nearly 1.2 billion in cash. So that's 1192.608. So we have that. We can now find our equity value. That is your enterprise value plus your cash, subtract your debt, and this is the equity value. This is what's left over for shareholders. We want to find the diluted shares outstanding, implied share price. Diluted shares outstanding is on the income statement down here. So we'll take this one, 343. We're going to do this in millions. So 343.528576. And your implied share price is you take your equity value divided by your diluted shares outstanding, which would indicate an implied share price of 133. So K100, let's equals K100 format it. So, I mean, there's significant downside, well, theoretically significant downside here if we put it onto a base case. Just see what the upside downside is. We go the implied divided by the current, subtract 1, put it into a percentage, minus 79%. So on a bull case, let's see where this is. 158. So yeah, I mean, it would you be quite brave to be investing at this level. But if we look at where the company was, I mean, it's in the last year, it's had this incredible run up to sort of, well, nearly $700 a share, based on optimistic forecasts. But yeah, I mean, it was coming back down to. We'll have to see where this drops out, but it's a difficult. It's well, based on these numbers. And remember, we haven't been that accurate with them. We've had to make up a lot of it based on because when it's so volatile like this, it's difficult to reliably forecast into the future. So we've had to use a bit of judgment there, and we'll have to see on the next earnings. They're restructuring the business by selling off the apps part. There's also a couple of investigations I think that are into them. So we'll have to see how those play out by the SEC. So yeah, we'll see what happens there. But yep, that's it really, and we'll move on to the next one. Thank you for listening. Bye.